monetary mechanics, fiscal dominance, and the all-important interest income channel. Stay tuned for a fantastic episode in which you'll learn a ton about how money works. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome Ritik Goyal. He is right now an author of the Monetary Frontier newsletter on Substack covering fixed income, interest rates, and the economy. He came from previously from Bridgewater and brings an equity research background as well as a global macroeconomics background. Ritik, thanks for joining us today.
Thanks for having me. I'm excited to be here.
All right, so I found your work because you were talking about balance sheet mechanics in the monetary system. I want to start right off the bat with my main question out to the internet, and you came in and responded. I read some of your work and I learned a lot from it. Let's talk about the monetary mechanics behind the Treasury creating money when it issues bills. So let me just set this up for the viewer for 1 second. This is the idea that when the government engages in fiscal spending, that money is introduced into the financial system. Now, from my perspective, I was thinking of it as that the Treasury has to raise money first from the market in the Treasury bill issuance or coupon issuance, and then it can spend that money into the economy so that the issuance of the debt is the primary event, the spending is the secondary event. Ritik said, no, you're thinking of it a little bit backwards. So start there, go into all the basics that you need, explain to us Treasury bills as an asset liability pair. Give us the whole explanation, please.
Great. Yeah, so it's a good way to start. So this is obviously a key question, given the dynamics of the COVID stimulus and the stimulus checks and those kinds of things. And the main thing is when the fiscal side, the government, the Treasury, when the Treasury spends, someone else is getting richer. So that's the kind of main balance sheet operation that is absolutely true. Is that when you see the government is $30 trillion in debt, that means that the government has a negative net worth of $30 trillion, and all of those dollars are assets for somebody else. So the kind of main contribution of MMT, which is one kind of framework for analyzing questions like this, is that the kind of traditional way we think about it is, the government has, a menu of options available to it when it's time to spend money. And that menu of options includes either, raising funds via tax income or like tax revenue, raising funds through borrowing, or then also, kind of working with the Fed or the central bank and then, printing the funds. And the Treasury can take one of these options and then deploy that cash. And the idea is, if we started with a system that had, no cash in it, the question is where would the government get the funds then to raise money and then spend? And so the way that, MMT and the way that I kind of think about things would answer that is that the spending actually comes first. And then the step 2 in the process is you can, independently tax, or you can borrow money, or you can raise debt. So just to work through sort of the balance sheet mechanics of this, we can think about it as there's two players that are kind of working against each other, sort of to say, which is we have the government. So you can think of the consolidated sort of Treasury and Fed balance sheet. That's one piece. And then on the other side is the private sector. So if one party goes further into debt or draws down their equity, then that should show up as an increase for the other party. So the way that I see it is the first step that happens when, the government wants to, build a bridge or build a bomb or send a stimulus check is the government doesn't say, shoot, where are we going to get that money? It's always just the government spends money into existence. So the first thing that, I would see as happening is the Fed credits whatever bank account, that it's the person who's paying. So let's say I want to give you a stimulus check and I'm the government. The Fed would say, okay, your bank account, I'm going to credit your bank account with the necessary reserves such that those reserves then can back up a deposit. So at the end of this first step of the transaction, The government now is further into debt because the Fed has more reserve liabilities. Those reserve liabilities then are assets for a particular bank, in this case your bank, and the goal of the transaction was to hand you a deposit. So those reserve assets for the bank will be matched by a deposit liability for the bank. And then that deposit liability for the bank is a deposit asset for you. And then you're simply richer. So your net worth has now increased. So that's step one. And so the interesting thing here is, again, it's the government spending first, which is sort of the first thing that happens. And then step two in the process is independently, the government can say, okay, I want to actually pull some of that money out of the system again. And they can do that by raising taxes or by collecting tax revenue. Or the government can say, I want to raise debt. So the way this would work is the government simply says, right now we have, on our balance sheet, on our consolidated balance sheet, we have reserve liabilities. What we want to do is replace those reserve liabilities with a Treasury security. So step two in the process, in the way that I'm describing it, is the government says, instead of having a reserve liability, let's raise a Treasury bill. So the government can then sell a Treasury bill. And the ultimate outcome of that is somewhere along the line, somebody buys that Treasury bill, hands the government back the reserve, and then essentially the reserve is extinguished. So now on the liability side of the government's balance sheet, it's no longer a reserve liability, it's a Treasury bill. But the same kind of flow exists, which is that there's still a liability on the government side, and that liability shows up as an asset for the private sector.
The Bitcoin Layer is sponsored by River. Make sure to check out river.com today or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today. Now, we have on the screen for you a slide that Ritik sent us that shows all of these balance sheets working together with the stimulus program here baked into the scenario in which the government is spending a massive amount of money and raising debt. So my follow-up question to you, you don't have TGA on here. So let's talk about the mechanics between TGA and reserves. And I really want to get into the details. What I'm hearing from you is that when the government spends first, you're not even assuming that there's money in the TGA. What you're assuming is that the reserve accounts get credited throughout the system, which would be a +1 for reserves and a -1 for TGA in the current, how it works. But what you're saying is that the +1 reserves are corresponding with a -1 reserve due from the government in the future? And is that what you're assuming? Please break that down so that I can really understand, because you don't have TGA pictured here. That's that's the Treasury general account for everyone else. That's the checking account of the government at the Fed, and what allows settlement between reserves and the TGA itself.
So just to clarify, the balance sheet at the top, which says U.S. Treasury, I'm essentially treating that as the TGA. So if we just walk through this, what I'm saying, happens when the government spends is, again, the first step is the government spends money into existence. So the Fed, has the ability to print reserves out of nothing. What happens is, I want to credit, a household's account. The Federal Reserve raises its reserve liabilities. So yeah, you're correct. The TGA has no part in this yet. The TGA can come second if it desires. The Fed raises its reserve liabilities, transferred those reserves to the commercial bank with the corresponding household. The reserves at the commercial bank rise, the deposit liabilities at the commercial bank rise, and then household deposits rise. So that's the process of the Fed the government essentially spending money into existence. So where the TGA comes in, so the TGA is sort of the checking account that the sort of central government has with the Federal Reserve, and the TGA transacts and raises various treasury securities and then collects reserves as an outcome of raising this debt. The second step then is if the Treasury wanted to quote unquote borrow money, and the reason I put it in quotes is because as I'm describing, the first step is that the Fed spends money into existence, or the government does, sorry. The second step is if the Treasury wanted to, raise bills or issue bills, the Treasury would, and then this happens through the primary dealers, which we can walk through. The Treasury will sell at an auction a Treasury security. Somewhere along the line, a primary dealer acquires funding to purchase those Treasury securities, but when the commercial banks acquire funding, and that typically happens through Repo, which we can talk about. When the commercial banks acquire funding, that means that some cash is already sort of in the system, and the point is that when the government has already spent money into existence, there is essentially more money available in the system to then go towards the purchase of these Treasury securities. So step two, which is the government raising debt. First thing will happen will be the TGA or the Treasury will say, I want to, do an auction, sell this Treasury bill. The government will sell the Treasury bill to a primary dealer, which is a bank with, a checking account with the Fed. The commercial bank will acquire funding through some sort of borrowing process. It'll acquire cash. It'll take that cash, hand it to the Treasury saying, okay, I'm giving you this cash, and in exchange, I want this Treasury bill. I want to acquire that Treasury bill. And now the Treasury has additional cash. It has more reserves on its balance sheet, on the TGA's balance sheet. So at the end of these two steps, the Fed has more reserve liabilities because the first thing that happened was that the government spent money. So the Fed has more reserve liabilities. The private sector, has more reserves, has more cash, has more sort of net worth. And then also the Treasury General Account has more reserves because the Treasury General Account issued new debt. So the private sector also has more, Treasury bills. So what's happening, in sum is that the reserves sort of cancel out in a sense, if you think about it at a consolidated level, which is that the Federal Reserve has more reserve liabilities, but the other side of the government, the TGA, has more reserve assets. So that's essentially a wash. What's actually in place is that the Treasury now has more Treasury bill liabilities. So that's the liability on the government's balance sheet. And that shows up then as somebody in the private sector who had cash, now they have a Treasury bill instead. So their purchasing power is unchanged. They're as wealthy as they were. And then somebody else, the stimulus check receiver, for example, has an extra deposit. So they're wealthier. So that's how I'm kind of seeing these balance sheet pieces.
Excellent. And so now let's get into my next big question. And I think our audience as well, they want to understand the next step, which is the commercial banking side, the primary dealer side, the repo funding side, because I think there's a misunderstanding, and I want to understand as well too. Is it new money or existing money? And you're saying that you're describing it as existing money, but from my understanding, it can come from brand new money if there is a way in which repo funding bridges a purchase of a treasury until a loan is issued or a deposit liability is created by a bank for the purchase of that bill from somewhere else. So that's what I want to get into next. Talk to us about the mechanics of a primary dealer acquiring that treasury, not having the cash in that moment, finding the cash in the repo market, but potentially that repo liability is created out of thin air by some bank, not coming from an existing reserve pool or cash pool. Please help us understand that next leg of it. So I guess maybe the punchline question here is that, do banks create money in the process of the Treasury expanding its debt supply, or is it coming from existing money?
Yes. So the first thing is when the Treasury issues a bill, I like to think of it as an asset swap, meaning that there's money like circling around in the private sector. The Treasury is going to take some of that back because it's raising debt essentially, and replace some of that money with a Treasury bill or a Treasury security. So in the process of issuing a new security, no one is getting richer per se, but that's not the same thing as saying no money is being created. But it is true that nobody's net worth is rising. But the second thing is when this process of funding that treasury purchase occurs, there is a little bit of a nuance of is there money being created or not. So typically, the way this will occur is that a primary dealer will have to, because these primary dealers, these banks, are essentially forced to kind of receive all the bills that or the treasuries that the treasury is issuing at an auction. The primary dealer through repo, which essentially means a short-term loan that's usually secured by the very security that the treasury is issuing, the primary dealer will secure funding through this repo loan, and then that funding essentially will be used to purchase the treasury. It depends on where this funding is coming from. So, on the other side of the repo transaction, there's all sorts of lenders. If one of those lenders is a different bank, and banks, have the ability to create money out of nothing, then what's happened is that both banks, both the primary dealer and the lender bank, expand their balance sheet together. So new money is created in the process, but no new net worth is created in the process. The lender bank, expands its balance sheet, creates new money out of nothing, and then it essentially hands that money to the primary dealer. The primary dealer then hands the money to the treasury and receives the treasury bill in return. So that process does create new money, because you can think of money essentially as balance sheet space or balance sheet capacity. Whenever a bank is expanding its balance sheet, it's expanding its liabilities, and its bank liabilities are money. The other situation though is if, let's say, the primary dealer acquires repo funding from like a hedge fund or a money market fund. In that case, that cash is already kind of sitting in the system. So if the primary dealer acquires funding through that mechanism, then it really is truly an asset swap, and no new balance sheet expansion has occurred. Because if I think about the hedge fund that's lending that cash, the hedge fund goes from having a deposit or some sort of cash on its asset side on its liability, and now it simply has a repo asset or like a repo loan as its liability, or sorry, as its asset. So in that case, if the repo funding is acquired from a non-bank, then that doesn't create new money, but the same sort of process occurs where this entity is lending money to the primary dealer. The primary dealer hands that cash to the Treasury general account. The Treasury general account then hands the bill in return, and that's how it occurs. But I think the more important thing is that when the TGA or when the Treasury is issuing debt, no new net worth is created. It's actually when the spending occurs, that's when the net worth is created. When the first step, which is that the government credits some sort of bank account, that's when the new net worth is created.
That is the main point to drive home here in Ritik's summary of the mechanics. It is that when the Treasury issues debt, it happens as an asset swap.
Yeah.
But when the Treasury spends money, that is when someone else gets richer, and that person or company is either a recipient of a direct check from the government or a government contractor. And so, in that way, the recipients of those funds become richer, and the whole system becomes richer when the Treasury spends. And the Treasury debt is one way to suck some of the money, but out of the system. But as Ritik is explaining to us, some of the money doesn't come from hedge funds and money market funds, which are funders in the repo market, right? Viewers know that that's the seat I come from, a 2A7 fund responsible for cash and lending that cash to primary dealers so they can fund their treasury positions overnight. That money that I was the fiduciary for, that money existed already. It wasn't new money created by a bank in a loan. So my next question to you then is that when a bank creates a repo, basically new money to fund a repo purchase for a primary dealer, the the primary dealer still has to send out reserves, or the primary dealer's bank still has to send out reserves to the Treasury. It can't send some repo transferred liability. So how does that portion work? Is it as if the reserves do get transferred to the Treasury, and then the bank on its own balance sheet matches that off, pairs it off, borrows reserves from elsewhere in the system? How does that part work?
Right. So that's absolutely a key consideration, which is that if a hedge fund who is the funder in this repo transaction sends cash, hedge funds don't transact in reserves. They don't have a checking account with the Fed, so they don't have any reserves on their balance sheet ever. What it could be first is the hedge fund in this case has a bank account with the bank, and when the cash is transferred to the bank, it's actually the hedge fund's bank transferring reserves to the primary dealer bank. It could also be that the hedge fund literally, or some other entity literally sends like a cash like instrument to the primary dealer. In which case, essentially, if at the end of this repo transaction, if the primary dealer bank, the one that's transacting with the TGA, if the primary dealer bank doesn't have more reserves on its balance sheet, it has more assets, but it doesn't have more reserves, which is what it needs to send it to the TGA, then it would have to do some sort of matched book kind of transfer where the primary dealer receives more of one kind of asset, a non-reserve asset, and then it has to give up more reserves to the TGA. And if it so happens that the primary dealer doesn't have reserves on hand, then it needs to go into the Fed funds market or the sort of interbank market and acquire those reserves. And in that case, the Fed can come in and supply that liquidity if necessary. So and then also, if the bank does have those reserves, then it can send those reserves, and it's still a wash in terms of net worth. But that's another consideration. Absolutely, is that the primary dealer banks, commercial banks, when they transact with the Treasury general account, they only do so with reserves. So there's only ever really reserves on the account of the TGA. Because if we think about the ordering, the sort of layers of money, it's the Federal Reserve. All the liabilities of the Fed are entirely reserves. The Fed only creates reserves out of nothing. It doesn't create, bank deposits out of nothing. And then the next layer is entities whose assets are reserves. So this is not households. This is not businesses, because none of us have reserves on our asset side on our balance sheet. It's the Treasury general account and it's commercial banks. And these parties all transact with reserves. So that's absolutely true.
Yes, and we are students of the layers of money here at the Bitcoin Layer. It's in the name. It's in the name of my book, Layered Money, because understanding the hierarchy of balance sheets is really essential to understanding how our monetary system works. There is a layering that is embedded in the financial system, and in order to see how money moves, you have to understand that it's moving actually up and down between layers. So it is it's excellent that you bring up that banks will have to go into the Fed funds market to find the reserves to send to the Treasury, and they might have to borrow those reserves or just lose the reserves as they gain a different type of asset in the system. That is a perfect segue to another question which I have for you, which is about the Fed's ample reserves framework, the quantity of reserves in the system today, the pace of, of course, the pace of the runoff of the Fed's balance sheet. That's
Yep.
really a secondary issue here. But what I care most about right now is what is the quantity of reserves that is necessary for the system? If we're only thinking about reserves from an interbank settlement, and not just interbank, but bank to Treasury settlement as well, you need the quantity of reserves in there to actually make the Treasury flow of trillions in deficit spending happen. There's a certain quantity of reserves that needs to be in the system. And mind you, this has absolutely nothing to do with credit creation down the line. Some people associate the quantity of reserves with the quantity of credit that can be issued by banks, but there is no physical reserve requirement anymore in the onshore dollar system. So it's not about credit creation. It is simply about plumbing. So what is your thought about the ample reserves framework? Powell mentioned it in the press conference last week that they're thinking about ample reserves. What is the quantity that you feel is the minimum? How are you thinking about reserves as the balance sheet runs down?
Great, yeah. So there's a lot here. So the first thing which you mentioned, which is absolutely true, is that banks really are never constrained by their reserves when it comes to lending. The thing that drives lending is there a good sort of loan opportunity out there? If there is, the bank will make the loan, and then after the fact, find the reserves to meet some sort of reserve requirement if it so exists. So what reserves are truly doing is sort of greasing the wheels between the players that transact in reserves, and that's the commercial banks, it's the Fed, and it's the TGA. So, in a world with scarce reserves or limited reserves, so that you can think of this is kind of like the era before the financial crisis, before QE rapidly increased the supply of reserves. The Fed was able to sort of set short-term interest rates through its management of reserves. And so this is what the limited or scarce reserves regime is like, where if the Fed wanted to raise interest rates, it could pull some of those reserves back, such that when banks are looking into the interbank markets to try to secure reserves, they would have to essentially pay each other a higher price for those reserves because they're more scarce. But after the financial crisis with QE, the supply of reserves has rapidly increased. The Fed's balance sheet is now something like 8 trillion. That means that 8 trillion reserves are somewhere else in the system, whether they're sitting at the TGA or they're sitting on commercial bank balance sheets. So the question of what level of reserves is at the very minimum necessary to support the sort of functioning of the system. It's an interesting question. I don't have a definitive answer, and there's all sorts of research being done on what that level is, because there have been periods in the past in the past few years, especially, where as the Fed is running off its balance sheet and engaging in QT, it produces these little moments where there suddenly is a perceived scarcity of reserves, and that causes interest rates at the short end, money market rates, to rapidly spike. A good, I think, example of this is the sort of repo crisis, or blow up. You can think about in 2019, where the Fed was in a similar kind of predicament, where it was running off its balance sheet, engaging in QT, and with QT, the total supply of reserves comes down. And it suddenly became the case that, partly because of that, there were certain commercial bank players that were unwilling or unable to provide that liquidity in the interbank markets. So the other flip side of that, though, is that, for the vast majority of monetary history, really, the system was able to work perfectly fine with no major blowups, with less than $100 billion in reserves in total. So before the financial crisis, the Fed's balance sheet was maybe couple hundred billion dollars in reserves, and bank lending was totally fine. So the key thing is that raising reserves, getting us to a level of ample reserves, doesn't induce bank lending, and then also constraining reserves doesn't necessarily reduce reduce bank lending either. So I guess the question of what level of bank reserves is sufficient, it's tough to really know until after the fact, when something goes wrong. In this cycle, there's been this another sort of nuance, which is the reverse repo program has been sort of like a sink for excess reserves, such that as long as the Fed has been engaging in QT, there's been another pool of reserves that has been able to come in and enter bank balance sheets as the Treasury issues bills and as the Fed runs off its balance sheet. If that reverse repo program comes down to zero, and it's come down substantially, it peaked maybe at like 2 trillion, and now it's down to a few hundred billion. If that comes down to zero, that will be one more sort of nail where we are entering a state where reserves perhaps are too limited. But those are some of the considerations. I wouldn't be able to put a number on what level of reserves is sufficient.
Of course, and there are some estimates, as you mentioned. There's some research at 10, 12% of GDP needs to be in reserves to help grease the wheel. But that is ignoring the quantity of Treasury debt that is hitting the market. So in your scenario in which there are only 100 billion or a couple hundred billion in reserves in the system worked fine. The Treasury wasn't hitting the market with a trillion net debt every year, year after year, and it's really a trillion to 3 trillion
Right.
if you look at the last 5 years, somewhere in that range. So it those have to be related, right? I mean, the necessity of ample reserves has to be related to the sheer quantity because, as you mentioned, it's the grease. So if there are too many treasuries coming, you need grease for all of that. So is that related, and is that what you're thinking about?
So I think it's absolutely related. The supply of treasury debt and the supply of reserves are related, but I would say more along the lines of sort of in the interim as the debt makes its way into the system. Because if we think about it, like if there was sort of this fantasy world where the way that the treasury issued debt is instead of giving you a stimulus check of 1,200 cash dollars, it gave you a stimulus check of 1,200 literal treasury bills. There's no real reason why like reserves are needed for that transaction where I hand you a treasury bill worth $1,200. The issue though is that that's not the way the system works. It's that the treasury has to actually work through this auction process where commercial banks and dealers that are limited in their own balance sheet and have all sorts of regulations, all sorts of sort of risk measures that they have to be cognizant of. When there's all of those considerations, then the process of getting treasury debt from being created at the TGA to entering the private sector, that system and that process, if there's not enough reserves to sort of provide that lubricant, that can create risks. So in a situation where treasury debt issuance is likely to be in the order of trillions, that does create a consideration for what the level of ample reserves is. But some of the research that thinks about reserves as a share of GDP, I think that sort of incorporates that idea where the treasury will issue debt, it'll spend money, that'll raise GDP, so it'll naturally raise what you would expect the level of ample reserves to be. So that's how I would sort of process that.
That's a perfect point to understand is that G is a component of GDP, meaning G meaning the government spending. So if the Treasury is issuing a lot of debt, it means it's spending a lot of money. GDP will be higher, and the amount of reserves will be higher to grease that system. So that's a very important point. The next question I want to ask you about is fiscal dominance. So we are in an era in which the deficit spending is so high that it's overpowering restrictive monetary policy, or we might even say that monetary policy isn't even restrictive given where fiscal policy is. So, what is fiscal dominance to you? Is it at play? How do you think about this? And now maybe is the time where you can explain to people why you study MMT. What is MMT? What does that mean to you? And perhaps I'm putting words in your mouth here, but why is it okay and not a bad thing that we have these absolutely mind-boggling deficits?
Sure. So I think we are absolutely in a state of fiscal dominance. You'll see tons of definitions of what that might be and definitions that differ in certain ways. The way I like to think of it is simply fiscal dominance is like a state where the policy choices by Congress essentially sort of neuter or they render the Fed's policy tools ineffective. And so, like you said, I think one way to think about this is that it's that the Treasury and what Congress is doing is overwhelming the Fed. But I actually see it a little bit differently, which is that it's not like saying Congress has a bigger gun than the Fed. It's rather saying that what Congress is doing is like removing the bullets from the Fed's gun. So a lot of the traditional monetary policy linkages that have held for however many decades, in a state of fiscal dominance, those monetary policy linkages stop sort of functioning the way we think. And the way that I think that's manifesting is that, so in a typical cycle, you have a recession, and the way that the system gets itself out of a recession is that somewhere along the line, the private sector is encouraged to start borrowing again, buying houses, buying cars, things like that. And that expansion in credit creation supports the economy and it allows for an expansion. In COVID, Similar thing happened, but not exactly, where in the COVID cycle, the private sector wasn't really the borrower in that cycle. The private sector was actually more of the lender, which is that the private sector got dumped by this huge incoming supply of treasuries and of fiscal stimulus, which makes the private sector more of the lender in this case and makes the government more of the borrower. And when that happens, and then you try to restrict the economy as the Fed by raising rates typically benefits the lender and puts pressure on the borrower. And if the private sector after COVID has deleveraged and has become more of a lender, then there's even an argument that raising interest rates is now a net support to the private sector because the private sector owns all these treasury securities that are now paying more interest. And so this is sort of the main contribution or the main kind of piece of MMT that I think is sort of turning heads, which is that the main baseline framework of analysis for MMT is that the government's deficit ends up being sort of net financial assets for the private sector, and that the more the government goes into debt, that's more assets the private sector necessarily holds. And there's this idea of the interest income channel, which is that in a world with extremely high public debt to GDP, meaning that the government is highly, highly indebted, all of those assets show up as assets for the private sector. And then when you raise interest rates, you're essentially raising the amount that those assets are paying on themselves. And if the private sector is holding all of those assets, then that's simply just interest payments that the private sector is receiving. And this is what's called the interest income channel. So, we've had recession calls since, the middle of 2022, as early as almost 2 years ago now. And there's many diagnoses for why that recession hasn't materialized. And one of those is that, yes, there is some hit to borrowing when you raise interest rates, you make, mortgages more expensive, you make cars more expensive. That is absolutely the case. But there's also this countervailing force as well now in the world of high public debt to GDP, which is that the interest income channel is now kind of playing out where each year the interest service alone is in the order of hundreds of billions of dollars. And that is, in some sort of intuitive respect, a little bit, frightening to think of, that the government is spending this much money just, staying alive and maintaining its own debt. But at the same time, that debt is assets for somebody else. And when the debt cost rises, the income from that debt for somebody else rises as well. And that money, that hundreds of billions of dollars, is showing up in the books of essentially anybody with money. So, one of the founders of MMT, Warren Mosler, who's sort of championed these ideas, he tends to refer to interest rate hikes as sort of basic income, but for people who already have money, because now their money, their treasury securities, their assets are all paying more. So that's what I think a world of fiscal dominance is, which is that the level of public debt to GDP is extremely high. And the effect of that is that the sort of way that the Fed thinks about its monetary policy now no longer really works, because trying to be restrictive is actually having all these sort of unintended consequences, such as paying more interest income.
Okay, so now what gets us out of the state of fiscal dominance? Is the Fed stuck? What has to happen for interest rates to actually restrict the economy, as opposed to what you are describing in the interest income channel, which is that interest rate hikes are stimulative to the economy as they dump more money into the economy? And by the way, that hundreds of billions in interest income, it's heading to $1 trillion by itself.
Yep.
So what is the way out? How does this situation resolve itself? When do you think we are due for a recession? Is it another few years away? How do you see this play out? And of course, I know that no one has a crystal ball.
Of course. So the way you can think of it, and this is how I sort of like see cycles play out, is that the fiscal government is sort of step one in the process. The government spends money. That's the fiscal transfer. And we've had an absolutely, gigantic one in this particular cycle. The next step is it's a political choice of, is that a level of fiscal spending seen as sustainable? Is it desirable? Does the public want it? So, one of the sort of consequences of that level of fiscal spending was we had this period of a very high inflation, and prices on a level basis are still much higher than anybody would have thought they would be going into 2020. And I think that's put some political pressure to reduce spending. At least there's obviously certain contingents of both people and the government that are sort of against spending at this time. The way that the cycle plays out then is that if we do see sort of a reduction in the government spending, what'll then happen is, savings for the private sector, the rate of growth in savings begins to fall. What does that mean? If savings are falling, if net savings are falling, then demand for credit, demand for new money by the private sector rises. So that, if that occurs in that way, would get us back to the sort of relationship between the government and the private sector, where the government's sort of doing its own thing. It's not really involved. It's sitting where it's not spending as much money as it could be, and the private sector is now becoming again the net borrower. So this is what you can call an endogenous money cycle, where it's not government money that's supporting the growth in the economy. It's bank money. It's new credits, new loans. That money is supporting the growth in the economy. But the issue with that is that that cycle, that endogenous money, is necessarily cyclical, because bank money, has an expiration date. It has a point where that money has to be repaid. And if we enter the stage in the cycle where it's bank money that's supporting additional expansion, and especially if that bank money is going towards things that are necessarily not as productive, so like financial speculation or consumer spending, then raising interest rates does absolutely have the ability to start becoming more and more restrictive. It's just that right now, where we are, where it's still the government spending that's funding this expansion, in that world, what we like to say at the Monetary Frontier is sort of like, the Fed is dead, or like the Fed doesn't exist at that point in the cycle. But I see this playing out as, hopefully, maybe at some point, fiscal dominance, sort of tampers down. There's less of a political will to spend. The private sector takes over. The private sector says, look at all these savings. We're rich. Let's do our own borrowing now. Let's keep the cycle going. That's the next stage. And then that makes the private sector more and more sort of sensitive to interest rates. And that brings the Fed back into the fold, where those traditional monetary policy linkages start to, make sense again. In that world where rates are continuously high at 5%, or they're raised even further to 7, 8, 10%, that's where you start to get the traditional kind of end to the cycle, where the interest burden by the private sector becomes unsustainable. You have to pull money from consumer spending to fund that interest service. That means less, spending, less buying things, and then that's how you end up with the recession. In terms of forecasting when that is, I do think we're at least a year to even 2 years out, just because I think the economy is still grappling with the magnitude of the fiscal expansion, and that's showing up as excess savings that I think still absolutely exist. That's how I'm seeing how this sort of plays out.
It's fascinating. And so, would you say it's a fair characterization to say that fiscal dominance is only dominant because the stock of private sector debt, which should be facing restriction from higher interest rates, it is losing by a margin that we can't quantify, but it possibly could be losing by a margin so thin that it could flip at any moment. And the reason I'm saying that is because we know that total debt in the world is north of $300 trillion. So a 35 trillion US Treasury debt stock can't necessarily be fiscally dominant just on a permanent basis. Would you say that's fair to say?
Absolutely. So that framework, absolutely makes sense. And so at the Monetary Frontier, one of the ways that we kind of track these is we have a fiscal impulse, which is the fiscal spending, and then what we call a monetary impulse, which is the private bank money creation. And what we've noticed is that, for the last couple of years, private bank money creation has been mostly flat, meaning bank loans. Bank loans have been in the range of, 12 to 13 trillion outstanding, and have been like that. They've been maybe growing a little bit, but not substantially. And it's the fiscal side that, like you said, is upwards of $30 trillion in debt, and a huge portion of that has come in COVID. So I would characterize, what we have right now as fiscal dominance, because if we look at, sort of the year over year changes in private money and public money, it's the public money that's expanded a lot and private money is taking the back seat. But it could absolutely flip where, the growth in public money isn't really that much, and bank lending, expands greatly. And I think there's a good argument that, that absolutely could occur, because what we saw when the Fed started raising rates is with, the senior loan officer survey and some of these measures, banks were saying, we're pulling back, we're going to stop lending, we're tightening our lending standards. And those banks sort of got burned because the economy was fine. There's no need to tighten lending. And so banks learned that lesson, and they're like, we can start lending, the economy's fine. That could kick off this sort of private bank money cycle. The federal government could then, take the back seat, because why do our own spending if it's just going to be inflationary, because the private sector is already doing its own activity. If we get that flip that you're talking about, then some of the linkages for how the Fed works through the system will absolutely start to play out.
People need to make sure that they are subscribed to our research publication, thebitcoinlayer.com/subscribe, so that you can follow along our analysis. I would also recommend you go subscribe to The Monetary Frontier. Correct me if I'm wrong, it's only $5 a month on Substack, and you are getting almost daily emails, in the weeds analysis on the monetary impulse, the fiscal impulse, what is going on in there. And Ritik has done some very interesting analysis looking into the work of Jeff Snyder, who people will know that I'm familiar with his framework and I've used his research. He has written about Lynn Alden's work on fiscal dominance. He's written about Andy Constan's work, who's been a guest a couple times on this show. Really interesting analysis where he's not trying to necessarily critique or disagree, but just break down the nuance. And I know viewers out there are encouraging us at the Bitcoin Layer to integrate different frameworks. We all have our own research process. We're all reading different things. One of the things that Ritik and I read as well, both of us, was something that Jeff Snyder recommended, which was the case for missing money, Milton Friedman's original work on the Eurodollar system. So I'm just plugging both of our research publications right now because I want people to learn, follow along with what we're doing. And Ritik, we hope that you'll come back on and talk about some more of these issues, get into how you feel about the way that Snyder has described the monetary system, the way that Lynn Alden is describing fiscal dominance and what's going on right now. All of these things are important. We want to continue to integrate different people's frameworks. We thank you very much for a ton of insight today. I learned a lot, and I'm going to continue reading your work and just try to keep learning more. So please plug your letter and where they can find you online.
Great. Yeah, no, I really appreciate it. This was a fantastic conversation. And like you said, you put it great, is, these are sort of complicated topics. Everybody has a dog in the fight. Everybody has an opinion. So the goal for us and for you and for really everybody is to see what people are saying, try to put those things together, see what really the differences are. And I think that's the hard work is, there's tons of smart people who have, hugely different opinions on these things. So the goal is, what are they saying and where are they disagreeing? And that's what, that's the work that I'm doing. That's the work that you're doing. So yeah, like you said, on Substack, The Monetary Frontier. And then you can also follow me on Twitter at RPGOYAL_. And then my partner, who I write the Substack with, George Robertson, you can follow him as well.
Great. Thank you so much, Ritik. And I'm Nick Bhatia with Ritik Goyal. We'll catch you guys next time. Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at the Bitcoin Layer, subscribe to our channel. Subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.